It was the weekend of September 13th, 2008. Saturday morning. Most Americans were watching football. Inside the Federal Reserve Bank of New York, the most powerful men in global finance were being called into emergency meetings, not casually invited, summoned. Treasury Secretary Hank Paulson was on the phone. Federal Reserve Chairman Ben Bernanke was on the phone. The message was simple: get to New York. Tonight. Lehman Brothers was collapsing. An investment bank older than the Civil War was running out of time. It had survived the Great Depression. It had survived world wars. It had survived every major financial panic of the modern era. Now it was days from bankruptcy. The losses were catastrophic. The market knew it. The government knew it. What nobody fully understood was what happened next if Lehman failed. Because Lehman was not an isolated company. It was wired into the global financial system itself. Banks all over the world were tied to its debt. Money market funds held its paper. Major institutions depended on the same short-term lending markets Lehman was now poisoning by the hour. And if confidence disappeared completely, credit could freeze everywhere at once. Not just on Wall Street. Across the entire global economy. The system depended on banks trusting each other enough to lend overnight. If that trust vanished, the machinery stopped. Payrolls, corporate financing, international transfers, the hidden plumbing underneath modern finance. Most people never saw it. Most people never even knew it existed. This video is not about subprime mortgages. Every outlet covered that story. This is about the hidden mechanism underneath the mortgages, the shadow banking system, the money markets, the overnight lending pipes that the entire global economy ran through. The infrastructure most people assumed was invisible because it had never broken before. But by September 2008, it was beginning to crack. Officials had one weekend to stop the panic from spreading. Before Asian markets opened Monday morning. That was the deadline. Find a buyer, build a rescue, or try to contain a financial chain reaction that many feared could rival 1929. Inside the New York Fed, executives from the largest banks in the world moved between conference rooms while regulators searched for a solution. The Federal Reserve provided the building. The Treasury Department provided the urgency. The banks themselves provided the problem. Though that part was not yet being said publicly. More than a century earlier, during the panic of 1907, J.P. Morgan gathered America's financial elite inside his private library and pressured them to stabilize the system before the panic consumed the country. The rescue was private. The authority was personal. This time, the room was larger. The stakes were global, and the authority belonged to the state. But the logic was the same. Save the system first. Ask questions later. To understand why that room mattered, you have to understand what Wall Street had built in the years before the crash. Not the jargon, not the acronyms, not the spreadsheets. Something simpler and far more dangerous. For years, the financial system had been turning weak mortgages into supposedly safe investments. The process accelerated rapidly in the early 2000s. Mortgage lenders issued loans to borrowers with shaky credit, little income verification, and sometimes almost no documentation at all. Historically, many of these loans would never have been approved. But Wall Street had discovered a way to package the risk. Thousands of mortgages were bundled together into mortgage-backed securities. Those securities were then divided into layers called tranches. The theory was simple. Losses would hit the lower layers first, protecting the upper layers from serious damage. On paper, it looked mathematically sound. Then the securities went to the rating agencies. Moody's, Standard & Poor's, Fitch, the firms responsible for judging financial risk, and many of these products received AAA ratings, the highest possible grade, safe enough for pension funds, safe enough for insurance companies, safe enough for money market funds, at least according to the models. The problem was deeper than bad loans. The problem was incentives. The banks earned fees for creating the securities. Mortgage brokers earned fees for issuing more loans. Rating agencies earned fees from the same firms whose products they were grading. Everyone in the chain made more money when volume increased. So volume increased. Fast. The securities spread everywhere, into retirement accounts, into municipal funds, into European banks, into the balance sheets of institutions all over the world. And underneath it all sat the same fragile assumption. American housing prices would keep rising. Then, housing prices stopped rising. Defaults began climbing, and the entire structure started to wobble. Because once the mortgages weakened, nobody could say with certainty what the securities were actually worth. And when institutions stopped trusting those valuations, they stopped trusting each other. Internal emails released later would reveal that even some analysts inside the rating agencies privately questioned the models behind the products they were approving. But by then, the machine had already grown too large. The profits were enormous. The bonuses were enormous. And almost every incentive inside the system rewarded more risk, not less. For a while, the alchemy appeared to work. Then it broke. And when it broke, the same institutions that helped build the machine turned to the Federal Reserve for rescue. On Monday, September 15th, 2008, Lehman Brothers filed for bankruptcy. It was the largest bankruptcy filing in American history. More than $600 billion in liabilities. Gone almost overnight. The weekend negotiations had failed. No buyer emerged. No federal rescue arrived. And so the firm that had survived the Civil War, 2 world wars, and the Great Depression collapsed before the opening bell. Markets reacted immediately. The Dow Jones fell more than 500 points. Global exchanges dropped in sequence across Asia, Europe, and the United States. But the visible losses were not the real danger. The real danger was underneath the markets themselves. Inside the short-term lending system, most people never see. Banks lend to each other constantly, overnight, hour by hour. The system depends on trust. Trust that the institution on the other side of the transaction will still exist tomorrow morning. After Lehman, that trust began to disappear. Banks that had been lending freely days earlier suddenly pulled back. They did not know which institutions were exposed. They did not know what toxic assets were sitting on balance sheets across the system. And increasingly, they did not know what collateral was actually worth. So, liquidity vanished. The lending market ceased. And in the absence of certainty, institutions did the only thing they believed would keep them alive. They stopped lending. What the public did not yet understand was how deeply connected the system had become. Lehman's collapse exposed a second layer of risk regulators had watched grow for years without fully containing. A single company had quietly insured enormous amounts of Wall Street's mortgage machinery. Not a bank. An insurance giant. American International Group, AIG. Through a London-based division called AIG Financial Products, the company sold hundreds of billions of dollars in credit default swaps. The idea sounded simple. If mortgage securities failed, AIG would compensate the buyer. Insurance, at least in theory. But the scale of the exposure was staggering. AIG had written enormous amounts of protection against mortgage losses without reserves designed for a nationwide housing collapse. For years, the arrangement looked safe. Housing prices kept rising. Defaults remained manageable. The premiums kept flowing in. Then the housing market turned. Mortgage securities began collapsing in value. Ratings agencies downgraded key assets. And suddenly, AIG faced massive collateral demands from institutions around the world. Now every major bank connected to AIG was asking the same question. If AIG cannot pay, who absorbs the losses? The answer reached across the global financial system. AIG was not simply large. It was deeply interconnected. On September 16th, one day after Lehman failed, the Federal Reserve intervened. An emergency rescue package. $85 billion. In exchange, the government took nearly 80% ownership of the company. Lehman had been allowed to collapse. AIG was rescued within 24 hours. The distinction would shape public anger for years. But one of the most frightening moments of the crisis did not happen inside an investment bank. It happened inside a product most Americans considered completely safe: money market funds. For decades, money market funds functioned as the financial system's cash drawer. Corporations parked billions inside them: payroll reserves, operating capital, short-term liquidity. The assumption was simple. A dollar deposited was a dollar returned. Always. That assumption shattered on September 16th, 2008. The Reserve Primary Fund, one of the oldest money market funds in the country, held Lehman Brothers commercial paper. When Lehman failed, that debt collapsed in value. The fund dropped below $1 per share. On Wall Street, the phrase is clinical: breaking the buck. But the implications were anything but clinical. Reserve Primary became the most significant money market fund failure of the modern financial era, and panic spread immediately. Institutional investors began pulling money from money market funds across the system. Not because every fund was insolvent, because the assumption itself had been damaged. If one supposedly safe fund could fail, others could fail too. And if money market funds were unsafe, then corporate cash reserves were unsafe. General Electric, McDonald's, municipal governments, major employers across the country, institutions far removed from mortgage trading or Wall Street speculation. Many kept operational cash inside money market funds because those funds were treated as stable as cash itself. Now that certainty was gone. This was the moment the contagion crossed into the real economy. Not just bank to bank, but Wall Street into payroll systems, into operating cash, into ordinary businesses trying to make it to Friday. Hank Paulson understood what was happening. He had spent more than 3 decades at Goldman Sachs. He had been its CEO. He understood the architecture of modern finance from the inside. And what he believed he was watching was systemic failure. Not a normal recession, not a market correction, a full-scale seizure of the financial system itself. On September 18th, Paulson and Ben Bernanke went to Capitol Hill. They met privately with congressional leaders. Bernanke, a scholar of the Great Depression, delivered the warning as bluntly as he knew how. If policymakers failed to act, the consequences could be catastrophic. Paulson arrived with a proposal. 3 pages. $700 billion. The Troubled Asset Relief Program, TARP. The initial proposal asked Congress for sweeping authority to purchase troubled assets from financial institutions. One section drew immediate attention. Actions taken by the Treasury Secretary under the program, the draft stated, would not be subject to review by any court or administrative agency. The request reflected the urgency of the moment. Credit markets were freezing. Confidence was collapsing. The damage spreading through the economy was already becoming visible. But the proposal also revealed something else. Who the government believed had to survive. The institutions at the center of the financial system. The banks. The funding markets. The balance sheets holding the machinery together. And the framework for that rescue had been drafted in just 3 pages, over the course of a single week. Congress said no. On September 29, 2008. The House of Representatives rejected the Emergency Economic Stabilization Act. The vote was 228 to 205. The reaction was immediate. The Dow Jones Industrial Average fell 777 points in a single session. At the time, it was the largest point drop in the history of the index. Retirement accounts lost value in real time. Pension funds absorbed billions in losses within hours. Washington interpreted the sell-off as a warning. Pass the rescue, or risk what came next. 4 days later, Congress reversed course. The Senate moved first. The House followed. On October 3rd, President George W. Bush signed the Emergency Economic Stabilization Act into law, $700 billion, authorized. The public had initially been told the money would purchase toxic assets from bank balance sheets. That was the theory. It was not primarily what followed. Paulson pivoted. Within weeks, the Treasury began injecting capital directly into major banks instead. Not buying bad mortgages. Buying ownership stakes. 9 of the largest financial institutions in the country received capital simultaneously. Several executives later described the process as less than voluntary. The government wanted participation to appear universal. Systemic, not targeted at specific failures. The objective was confidence. If every major bank accepted capital, then no individual institution appeared uniquely weak. That was the strategy. Stabilize the system first. Sort out the politics later. While Congress debated and Treasury negotiated, the Federal Reserve moved on an even larger scale. Ben Bernanke had spent much of his academic career studying the Great Depression. His conclusion was clear. The Federal Reserve had allowed the Depression to deepen by failing to provide enough liquidity when the financial system began collapsing. He was determined not to repeat that mistake. In November 2008, the Federal Reserve formally launched the first round of quantitative easing. QE. The mechanism sounded technical. The implications were enormous. The Federal Reserve created new money electronically and used it to purchase financial assets. Treasury bonds, mortgage-backed securities, including large quantities of mortgage-related assets at the center of the crisis itself. The goal was to stabilize markets, lower borrowing costs, and force liquidity back into the system. There was no clear historical template for the scale involved, and no fixed endpoint. The programs expanded repeatedly over the years that followed. By the end of the major QE rounds, the Federal Reserve's balance sheet had grown from under $1 trillion to more than $4 trillion. Much of that liquidity flowed into financial assets, stocks, real estate, bond markets. The recovery arrived unevenly. Asset prices rebounded relatively quickly. But for millions of Americans who lost homes, jobs, or savings, the recovery moved far slower. While the rescue unfolded, another process was happening quietly underneath it. The crisis was eliminating weaker institutions, and larger firms were absorbing the remains. Bear Stearns had already collapsed months earlier, in March 2008. With Federal Reserve support, J.P. Morgan Chase acquired the firm at a fire sale price. Initially, $2 per share, later revised to $10. A company that had traded above $170 a share the previous year was absorbed by a rival with government assistance, helping structure the deal. Then came Washington Mutual. At the time, the largest savings and loan institution in American history. More than $300 billion in assets. Federal regulators seized the bank in September 2008. J.P. Morgan acquired it the same night for $1.9 billion. Merrill Lynch, facing its own collapse, agreed to a takeover by Bank of America under intense pressure from federal officials seeking to avoid another Lehman-style failure. Wachovia was acquired by Wells Fargo. National City by PNC. Across the system, the same pattern repeated. The institutions at the center of the crisis did not disappear. They consolidated. Upward, into fewer firms, larger balance sheets, greater concentration. The financial system that emerged from the crisis was more centralized than the one that entered it. Here is what the numbers show. Before the crisis, the largest American banks already controlled an enormous share of the financial system. After the rescue, their position became even larger. The institutions considered too big to fail in 2008 emerged from the crisis more concentrated, more interconnected, and, by the logic of the rescue itself, even harder to allow to collapse in the future. The public was told the bailout succeeded. On one level, that is true. The financial system did not fully collapse. The ATMs continued working. The payroll system held. Global finance survived the panic. But many critics argued the accountability mechanisms never matched the scale of the rescue itself. And the deeper structure that produced the crisis remained largely intact. The concentration of risk. The dependence on massive interconnected institutions. The assumption that catastrophic failure would ultimately force government intervention. That structure survived, and in some ways, it expanded. Economists have a term for this dynamic: moral hazard. When institutions believe the cost of failure will be absorbed by someone else, incentives change. Not toward caution, toward greater risk, more leverage, more complexity, more of the behavior that generated profits before the collapse. The 2008 rescue did not eliminate the moral hazard inside the financial system. For many observers, it reinforced it. It demonstrated that when the stability of the system itself was threatened, the government would intervene at extraordinary scale. The costs of the crisis did not fall evenly. Millions lost homes. Millions lost jobs. Retirement savings were damaged across the country. And while many households spent years recovering, large financial institutions stabilized far more quickly. In 1907, J.P. Morgan gathered bankers inside a private library and forced a rescue. In 2008, the rescue came through the balance sheet of the state itself. The room had changed. The scale had changed. But the underlying logic remained familiar. The system would be preserved, whatever the cost. And the institutions at the center of it would remain standing when the panic passed. Now consider what that actually produced. The 6 largest American banks held roughly $10 trillion in assets before the crisis. Today, they hold more than double that. The firms that were too big to fail in 2008 are significantly larger now. And the pattern did not disappear. In 2023, 3 regional banks failed within a matter of weeks. Silicon Valley Bank, Signature Bank, First Republic. The resolution was familiar. The giants absorbed the wreckage. JP Morgan acquired First Republic, the same bank that absorbed Bear Stearns, the same bank that absorbed Washington Mutual, a direct descendant of the private empire JP Morgan built in 1907. Moral hazard is not a side effect of the system anymore. It is a permanent feature of it.